being run by EGROW Foundation. As you know, Foundation for Economic Growth and Welfare is a policy-oriented think tank recently been set up in NCR region. Our focus is on contemporary issues, and we try to get the best minds across the world to come and speak to us on policy issues. We also invite young, absolutely young scholars and researchers who are doing research in various parts of the world to come and discuss with us about their research. In that context, today we have two young researchers coming and speaking to us. To chair the session today, we have Professor Dholakia from he was a former professor at IIM Ahmedabad, and he has been a very, very popular scholar in our country in areas of research and economics. He has published extensively in various journals, and more than that, he has been, and to me, that's a very important assignment that he was doing. He's been with the Monetary Policy Committee of the Reserve Bank of India. He's been into academics for nearly 41 years. That's a long time. He has also been visiting abroad in various universities across the world as visiting faculty. He has also been a member of several government committees, some very high level committees, and he has been contributing to policy making. He has been also a member of the expert committee on public debt management, which I think is again a very important committee of our country. So he has played an extensive role in policy making and also is a very rigorous academic professor. As we were just talking, he's also been helping Niti Aayog in doing projections and offering comments and observations on work that we are doing for projecting India's growth in 46-47. So with that brief introduction of Professor Dholakia, I hand over the session to the professor to conduct the proceedings further. Professor Dholakia.
Thank you, Dr. Charan Singh, and welcome to the two young researchers. I think we have on our hand a very thought-provoking and a very comprehensive kind of a study, first of its kind, as the authors claim, on the tax incentives, small businesses, and physical capital reallocation. Well, Dr. Manpreet Singh from Georgia Tech University is going to make a presentation, and thereafter we will have as a discussant, the comments by Lakshmi Naaraayanan, who is with the London Business School. I think without getting into the further details, I would request Manpreet to start his presentation. Shall we have about 45 minutes, 50 minutes presentation, or would that be okay?
That's fine. Yeah,
okay.
So we can go for 30 or 40 minutes. I think I have like 25 slides, and I think what we can do is that you can ask me questions in between instead of postponing all the questions to the end, because I think that helps a lot.
No, Manpreet, it will be a chaos if people start commenting and asking questions. I would say if there are clarificatory questions, most welcome. Most welcome. But the substantive questions or comments can follow the discussant's presentation after your presentation. In fact, it is the discussant's prerogative to first comment on your paper.
Sure.
And therefore, I would not say that you restrict your presentation only to 40 minutes or so. You make it 45, 50 minutes, no issues. But make it clear. That's all. That is the point. I mean, my expectation is that 25 slides will take you to about 45 minutes. Anyway.
Yes.
Lakshmi, you will thereafter follow with your comments, specific observations, etc. Would 5 to 10 minutes be okay, or you will require more?
Initial email, I think, said about 20 minutes, but I'm fine with 5-10
No, no,
minutes.
no, no, no. Initial, if it has said 20 minutes, make it 15 to 20 minutes, okay? So 20 is an upper limit. And then we will, open the floor for comments and discussion and questions, okay?
Okay, sounds good.
So that will be the thing. All right.
Yeah.
So here goes Manpreet.
Firstly, let me thank Dr. Charan Singh and then Professor Ravindra for introducing to this session, and again thanks to EGROW for letting us present our early work. So this is a joint work with Doy and Kim. He's at Northwestern, and Riddha Basu. He's at George Washington University, and the paper has titled "Tax Incentives, Small Businesses, and Physical Capital Reallocation." So let me just make sure my slides are working properly. Okay, so what we're going to do in this paper, the basic question we're going to ask is, do tax incentives, and I'll be more clear as we go forward which tax incentives I'm going to talk about. So do tax incentives foster capital reallocation towards small businesses? When I'm saying, so there's a large literature on capital reallocation, which basically talks about how the financial capital moves in different sectors. But in this paper particularly, we're going to talk about the physical capital, and I showed you some of these things in the first slide, like the pictures of equipments. So we're going to talk about how these physical capital, which is tractors or trucks or whatever, all of that physical capital, or the machine tools or printers, how they move across firms. Okay, so that's basically the thing we're going to see, that whether if you give incentives to the firm, and especially these tax incentives, does it help moving capital towards small businesses or not? Okay, that's basically the research question we're going to ask. And the why we're going to ask this question, the idea is straightforward, which is so there are direct benefits of tax incentives, and I'll be more clear which incentives I'm going to talk about. But there are direct, when you give incentives, firms directly benefit from these incentives, probably make more investments, while there will be some indirect benefits. So this is the first paper we're going to talk about this indirect benefit, which is in terms of the capital reallocation. When you give incentives to the firm, probably they just take action based on the incentives you are giving to the firm, while there could also be these indirect benefits to other businesses which are in a general equilibrium. And this is what we're going to talk about, and especially we're going to discuss how this capital reallocation effect is going to work. So what we are going to look at in this paper, we're going to look at 3 episodes of federal investment stimulus. So I think there is this large literature on how you can sort of motivate firms to invest. Okay, and in US, one particular type of incentive which is typically given is helping the firms in depreciating their asset quickly. Okay, so I'll be more clear what does that mean. But the idea is to think about, you have an asset, you have bought a physical asset, which lasts for say 5 years or 10 years. And it's also I think in India or in a lot of countries, what you do is that you follow an accounting rule, and you say that okay, this asset is, says the life of this asset is say 5 years or 7 years or 10 years based on the accounting rule. And now what you're saying is that you don't have to wait for 10 years to depreciate the asset. Right? Think about, like, if you buy a car, even and you sort of, or you're a truck for your business, right? You can depreciate it, and you can depreciate it only to the lifetime of the machine. But now what I'm saying is that the federal tax incentive is that you can depreciate that asset immediately, or probably in a better schedule. So that's basically the incentive we're going to talk about in this paper. And there were actually 3 episodes when the stimulus was given, where you're accelerating this process of moving all the future depreciation to today, which basically means you're expensing the asset today itself. So you're cutting down your tax bill. Okay, that's basically the idea. And these episodes were, these 3 episodes were in 2001 to 4, which was during the dot-com bubble, then around the financial crisis, and then the most recent tax cuts, tax bill under the Trump administration. Okay, and what we're going to look at is the treatment and control group, which is basically the industries where you have assets which are of long duration, which basically means that your assets are say 5 years or 7 years or 10 years. And then you have industries where your typical asset age would we say 2 years, 3 years, or 5 years, right? So that's the variation I'm going to look at. So think about an industry where most of your asset age is like say 10 years or 15 years, while the control group is the industries where your asset is probably 3 years or 5 years. Okay, so that's basically the treatment and control group setting here. So what's the large literature? Okay, so there is, I think the tax incentive literature is getting bigger and bigger with time. So firstly, these incentives are not permanent incentives. Okay, these incentives are typically temporary. And the idea, which especially these accelerated depreciation, as I explained before, is to sort of work as a counter-cyclical policy. You have a downturn and you want to sort of, incentivize the firm to invest. And the easier way to invest to tell them that, if you buy an asset today, you don't have to wait for say 3 years or 5 years or 10 years to depreciate the asset. You can expense that asset immediately. And if you can do that, which basically means that, you have these incentives to sort of, invest immediately. And this is what the policymakers' objective was, that if I need to sort of encourage firms to make investment, all I tell them that if you make an investment, you can expense it immediately, which basically means your current tax bill is going to be lower, and because your current tax bill is going to be lower, you have incentives to invest. Now the question is whether these incentives are working or not. Okay, so the early work, which is with Desai and Goolsbee and then House Shapiro, they use the large firms in the United States, which is using the CompuStat database, and they do not find a significant effect on the investment. If you give incentives to the firm, so they didn't find anything that the firms are investing more than these incentives are given. Okay, especially the larger firms. But later on, more data people started collecting on the small businesses, and what they show is that there is actually a positive effect of these incentives. So basically, there is a huge heterogeneity. Not all businesses react to these incentives. Only smaller businesses react to these incentives. So think about, like, if I'm a firm and I'm giving this incentive, if I'm a government, I'm giving incentives, I need to sort of figure out that, who's going to react to this. Like, are small businesses going to react to this and going to make investment, or the large businesses are going to react to this and make investment? What the research kind of shown so far is that there are firms who react to these incentives, but not the bigger firms. Probably the smaller firms react to these incentives. So this is the idea of investment. But then people started also looking at the effect on labor. Okay, so the point of the labor is that the whole idea of these incentives is that you encourage firms to invest, and the firms invest, they will hire people, right? That the whole idea of like counter-cyclical policies to make sure that the firms makes investment, and these investment helps from hiring more people. So whether any questions? I think there's some. Okay, so that's basically the idea of these incentives of like encouraging firms to hire people also. So what's being shown in more recent papers is that there is also positive effect on labor, and also there is an effect of some kind of a automation kind of thing. What's being shown that not all workers get positively affected by this. In fact, when you give incentives to the firm to invest, some of these firms also invest in computer software. Okay, and when these firms invest in computer software, they will cut down their routine task workers, and it actually increases the skilled workers. Although it's good for the skilled workers, these incentives, but they're not going to employ too many people. So what you see is this distributive effect of these incentives based on the type of work you're doing. So this is basically, in a nutshell, what has been done in the literature from the investment side and on the labor side. And what this paper is going to talk about is the effect on the capital reallocation. So why capital reallocation is important? Okay, I can give a pause for a 10-second or so if there are any clarificatory questions. Otherwise, I can just move on. Okay, so there's no questions. So why capital reallocation? Okay, so this is large literature starting from Solo. When you think about economic growth, and especially this foundation is all about economic growth, new capital goods are important, right? You want firms to sort of keep investing in new technology, new capital goods, so that you have you have increased economic growth. But at the same time, used capital is also important. And the reason why used capital is important, because it can also serve as an investment for many small businesses who cannot buy the new capital. Although you always want firms to invest in new capital goods, or get and adopt the new technology, but not all firms can do it, because in this world we know that not everyone is, financial constraints are binding. Not all the firms can afford to invest in the new technology. So what basically it means is that not all firms going to invest, which basically means that some firms won't be able to invest in the new capital, and they'll be actually relying on the used capital. And there's a used market I think in all the countries are getting bigger and bigger, because the average age of the machines and the average age of utility of the machine is also increasing. So which basically means that even if the technology is not new, you can still use these older machines, and also make investments and growth and everything for the small businesses who cannot afford the new capital. So the state of the art thing is that the constrained firms are typically, or when I say constrained, it's basically the financially constrained firms. They're typically the buyer of old capital. And more recent work also showed that the local availability of old capital helps business formation. So think about I'm living in Georgia Tech here, right? I'm in the Fulton County, and suppose I want to start a business, okay, and I don't have enough capital in my hand, I don't have enough cash in my hand, or I'm not able to borrow a lot of money, and I'm thinking that should I buy a new capital or should I buy an old capital? Okay, when I'm saying capital, I'm always talking about like an equipment, right? Like it could be a tractor, it could be any equipment will be used in the construction, or a printer, it could be any of those things. Okay, so it's a physical capital I'm talking about. So if I want to make an investment, I want to buy an equipment, then should I buy a new one or should I buy an old one? Okay, and if I see that the old one is easily available around me, which is when I'm saying the local availability, is basically thinking about the supply of that old capital is available to me nearby. It actually, what's being shown, it helps in business formation. So think about, like, if I want to start a business and I'm like, not only I'm looking for, going to the bank to get the cash or to get the capital, the financial capital, but with that financial capital, at the end of the day, I'm going to buy the real physical capital, right? And should I be buying an older one or a newer one depends on the price of that capital. And typically, the new machines are expensive, old machines are cheaper. And if the older machines are available in my county, in my local area, then I'll be more likely to start the business. And this is what's being shown so far in the literature. Okay, so basically the nutshell from this slide is that new capital, ideally you want firms to sort of invest, but not all firms can invest, and financially constrained firms typically invest in old capital. So now I'm going to sort of get to the question that I'm going to ask in this paper, is that tax incentives, if I give tax incentives to the firm, and especially if I tell you that if you buy a new capital, it will be subsidized. Okay, so when I'm saying subsidized is in the sense that if you make an investment in a new equipment or a new machine, then you'll get certain tax benefits. Okay, so how does it going to affect the firms? Okay, so this is what exactly the tax incentives which federal government has offered in 2001 to 4 and also in 2008 to 2010, that I give an incentive to make an investment in new capital. Okay, and now the question is, how does it affect the purchase of the vintage of the capital? Are firms buying new capital or are firms buying old capital? So the direct effect is that I give an incentive to make an investment. What do you find is that, okay, some small businesses directly benefit from these investments, because now earlier probably this machine was probably 100,000 or something, and you give this incentive some on the tax deductible basis, because your tax bill is going to be lower in the future. And I'll get into the details of how these incentives work, but just to sort of get to the theory, that you give the incentives to the firm and they'll say, okay, let's go ahead and invest in new capital because now it is subsidized, right? You're giving a subsidy on investment in the new capital itself, and the firm is going to invest. Okay, which basically means that you're going to invest in these kind of new capital instead of buying an old tractor. But there could be an indirect benefit of, these tax incentives to some firms who are not investing in the new capital. And this is what the paper is going to sort of get deeper into this. Okay. So there are, as I mentioned before, not all firms can actually afford to buy a new capital, even if you give them tax incentives. Okay. Even if I tell you that, this product is going to be cheaper and subsidized, why don't you go ahead and buy a new capital? I may not even have sufficient capital, sufficient, when I'm saying capital, I don't have like a sufficient real capital or financial capital to go ahead and buy a new machine. Okay. So if I don't have enough capital to buy a new machine, I would always prefer to buy an older machine, which is the standard case. So how these incentives help is that I give you an incentive to go ahead and buy, a new machine. When you go ahead and yes, Ravin.
One clarificatory question from my side.
Yes, sure.
It seems you are assuming that the supply of the new machines is infinitely elastic.
Yeah, so the equilibrium effect, I think the model kind of assumes that, but whether the story I'm saying is going to hold is basically depends on how, what's the shape of the supply and the demand curve.
No, what I'm saying is that you are assuming that the price remains the same. Therefore, if the tax incentives are given, they will be considered as a net benefit, because otherwise what happens is that when the demand increases, the price of the machine will also increase, and to that extent the effect of the incentives would be less. There will be some positive is there, but is likely to be less. That is the whole issue. Yeah.
Right.
Anyway.
So what I'll do is that I'll check that in the data, whether it actually pushes up the price or not. So I think your observation is correct that, we don't know, right? If the supply is like perfectly elastic, then, right. So then, but I think what I'm going towards is that obviously this is a direct effect. Whether direct effect is also effective or not depends on, how flat is your supply curve.
Exactly.
Right?
Exactly.
But also at the same time, but I'm going to also talk about the indirect effect, which is when I buy new capital, I also, I'll be selling some of my old capital. When I'll be selling my old capital, there will be enough old capital available in the market, if there is. Okay, so all depends on if and then conditions. If that's true, then it will probably cut down some of these, price of the older capital too, because now there is enough supply of old capital, and there's not that relative to the previous equilibrium, which means that there will be a decline in the price of old capital, and now there's a decline in the price of old capital. Now the firms which were not able to afford the new capital, they can actually, even the older capital, they can now afford and buy the older capital. So the story has, these conditions on like, how the price is going to move, right? How these incentives are going to affect the price of the new capital, and how these incentives are going to affect the price of the old capital. If as you mentioned correctly, that, if these incentives push the price more to the new capital, right, then these incentives, it again depends on like, how elastic is your supply curve, right? If it is perfectly elastic, then yes, right? If it's inelastic, then it's a completely different story. So it really depends on how your supply chain is going to move, and how it's going to get affected. So that basically is like a testable thing in the empirics. And similarly, it's true for how much if the new effect is not working, right? If not enough firms are buying new, then obviously they won't be selling their old. And if not enough firms are selling their old, then there will not be enough old capital available to push the price of the old capital down, right? So it's all testable in the theory that, whether all those things are there or not. And that's basically what we're going to do in the paper, is to sort of see, how much of these direct effects are there and how much of these indirect effects are there. And if they are there, then, how big is those effects, and then how they're going to affect, the firm entry and all of that. So that's basically in a nutshell the hypothesis of the paper, like looking at the direct effects and the indirect effects of these incentives via, the price of old and new capital.
Now just a further quick clarification, because the way you have explained your hypothesis, the null and the alternative, there is no place for the second tail. It is only one tail. Am I right?
In what sense? I think yeah, so I think so there is always debate, right, that whether these incentives are going to work or not, right? So I told you a story where, that if the incentives have to work, this is how they work, right? But in the null hypothesis, most of the firms, if none of these things will happen, this is your null, right? Like none of these effects will be there.
Correct. So that I am not questioning about the null. The way you have explained the entire thing, the alternative hypothesis only is on one direction. It is not on both the direction.
Let me think about it. For which one? Like the tax incentives one, or
that is, both the incentives, both the things that you are talking about will be only in one direction, not in both the direction.
Yeah, I think the way I explained you the first side, right? But again, it all depends on, I think I assume that the financial constraints are not binding for all of them, right? So if, the direct effects will also work only for the firms, who think they get benefited out of it, So I think that's basically the way I think about it, right? Because the older literature always sort of find that these incentives are not working. So if you think from the older perspective, that the benchmark is already, the previous literature says that these incentives are not working, and then there's a question that why these incentives are not working, right? So you can consider that as my null hypothesis too, right? That these incentives are not working, and then people started looking at it's not all the firms are sort of moving, it's only some firms are moving. So I think Imtiaz, you also think what is your null hypothesis? I think my null is basically that these incentives are not working.
I know. Null, there is no question. I'm talking about because you will apply some t-test or whatever test, right?
Yes.
For the significance. That is always having two tail or one tail. And my question is about one tail or two tail.
I think I'm looking. So I think what you're saying is that why? Let me put it the other way around, right? I think what you're asking me is that whether the firms are. Let me start with the first one, right? Like I think what you're asking me is that I give these incentives to the firm, whether the firms will buy new. I think if I just look at the first one, right? It basically means that you give incentives to the firm and you tell them buy new assets. Okay. How much they're going to buy or not, I think that's what I'm trying to ask. Okay. So it's basically two-tail in that sense, right?
No, because nobody is.
I think it is one tail. It is one tail because in first hypothesis, you have taken that purchase of new assets. That is, you have taken only purchase. That is addition. Not you don't have taken the decrease in that. So it is one tail. And similarly, in second hypothesis, you have taken more purchase of old assets. Again, it is a one tail. And in third hypothesis, you have taken reduction in relative prices. You hadn't taken increase in relative prices. Again, it is one tail. I think so.
Absolutely right. Absolutely. I agree with you. That was the question that I was asking.
Okay. Okay. Yeah, go ahead.
It is absolutely one tail in each and every case.
Yes.
Okay. I think I haven't thought through that. So thanks for giving that comment.
Okay. Please go ahead.
Yeah, sure. Thank you. So basically, these are the three hypotheses we're going to test that that whether I think most of my tests are two tails, but yeah, I can check probably the one tail side of the test too, because I think as of now what I'm doing is I'm just doing the two tail test instead of one tail test. So what we basically test is this direct benefit, which is I give an incentive, go ahead and buy new capital. Are you going to do that or not? And second is that if these incentives have any capital reallocation effect, then more purchases of the old assets by more constrained firms, which is basically the alternative, right? So think about I think what you're asking is the alternative here, right? Think about an H2 here, right? In this second hypothesis, if you think that firms are financially constrained and there is no capital reallocation effect, and the firms are I cannot buy new capital, if the capital reallocation effect story has to work, then more older assets to be bought by the constrained firms. But if it is just the direct benefit of the taxes, then the firms are constrained before to buy new capital. Now I, give them incentives and they buy just new capital, which basically means that this whole capital reallocation story is not working, right? So what if your capital reallocation story has to work, then the constrained firms are still buying older capital and not the new capital. That's basically, if you think from that hypothesis, this is where my dual hypothesis is going to come in the H2, that if it is the indirect effect, then it's the capital reallocation effect, right? If it is a direct effect, then even when I was constrained, I was not buying new capital. Now I'm less constrained, I'll just go ahead and buy new capital, right? What the capital reallocation story says that even if you're constrained, some firms will continue to buy older capital because the older capital is cheap, right? So think about this as an extensive margin for some of the firms. And I think that's basically I'm going to sort of test in the paper. And all of this is going to work through price of the old capital and the relative price of old capital and new capital, like how much the old prices are moving and how much the new prices are moving. Okay, so let me sort of get into the details of the tax structure and the incentives. Okay, so in US, so all of this is under this section 168, which basically means, so think about this schedule here. So in US, before these tax incentives, suppose you are you are depreciating your asset, then in the first year of purchase out of that asset, you're going to depreciate 20%, and then you follow whatever the schedule of depreciation. It will be 20, 20, 20 for the next 5 years, again depending on the asset type, right? So what the government did is that I'm going to give the incentives to the firm. Instead of first year deduction of 20%, you can actually deduct 30%. And in fact, in 2004 and 5, they said, you can actually deduct 50%. Suppose you bought a machine for say $100,000, you can immediately expense 50% of it. Okay, and in the financial crisis, this 50% was again, these things were in the first phase, and then again, this is temporary because for the first couple of years it was there, and again they said let's drop this whole incentive thing, and again during the financial crisis they increased it, and in fact in the peak of the financial crisis they increased the incentives from 50%, especially from 20% to 50%, then 50% to 100%. So which basically means that if you buy an asset today, then you can depreciate everything right away. Okay, so which basically means that you have enough incentives to buy capital if you have enough capital, and if you have like enough real capital, then you have incentives to buy because you can cut down your tax bill immediately. Okay, so let me just sort of give you a quick example from this. So a total investment a company makes in a tax year, say 2004, and they acquire say 10 new machine tools, where total cost is $150,000. Okay, for federal taxes, the first step is so again I'm going to talk about two types of incentives. One is 168K and there is 179. Okay, so it has to be clear how they're working. Okay, so first is for the first 100,000, you can expense everything immediately. So which basically means that under this section 179, if you have made an investment of $150,000, so the first 100,000 goes off immediately. So it lowers your federal tax returns by almost 50,000. Okay, so this is a 100,000 reduction you get from the 179. And then comes the bonus depreciation, which is what these incentives that I'm going to talk in this paper. So what also you can do is that you can take a bonus depreciation of that 50,000. So 50% of that 50,000 is 25,000. This is extra deduction that you get on top of this 100,000 that you get from the 179. So you get 100,000 from the 179, you get 25,000 from the 168K, and then you follow the standard depreciation rule. Okay, so you have already deducted 125,000 from this 150, so you are left with this 25,000, and on that 25,000 you will deduct again 20%, which is just based on your regular maker's rule. Okay, so how much have you deducted with or without incentives? Okay, with incentives, suppose you have bought a machine, 10 machines for $150,000. You, with these incentives, you would have deducted 130,000 right away in the year of investment. and rest of, whatever the 13% left, that get, follow this particular schedule of 32, 19, 11, 11, 5, whatever is the leftover amount, right? So that's basically the thing. So the leftover of 20,000 is basically, deducted from your tax bills, the depreciation expense based on these numbers. Okay, so that's basically the idea, right? That if you have this first layer of incentives of 179, but you have this extra layer of bonus depreciation, and this is the variation I'm going to use in the paper, where I'm going to say that, so this is the time series variation, right? In some years it was 50, in some years it was 30, in some years it was 20, in some years again it was 100. So that's the variation I'm going to use in terms of the time series, and I'll come back to the cross-sectional variation. So again, let's just to give you a simple example here. If you follow a standard, maker's rule, which is a simple accounting rule, then this is how you deduct, right? The first year you deduct 20%, then you go for 30, and then, again 20, lower than 20, and then all of these numbers. While if I give you bonus depreciation, like in the previous example, you can immediately expense everything today, which is 100%, right? So that's basically the comparison we're going to do. Either the firm is following this blue thing, or with the incentives, the firm is following not just this red, could be 50 or 30 or 20, depending on which year you're going to talk about, right? All these were temporary incentives, so we're going to look at each of those years separately. So what's the industry variation? There's a little bit of math here. So what we are going to do is that we're going to calculate, how much is the per dollar tax shield benefit. If you have a tax rate of tau, then how much is the tax shield benefit? Okay, so this is the measure. I'm going to call it at Z0. Okay, so this is your first year deduction, which is I call D0. And for the rest of the years, again, there's a future discounting. So that's basically, I'm assuming some R of discount rate, and this is basically the deduction. I'll send the slides, okay, for the future. So if you think about the present value of a dollar with the maker's rule, what you basically see is that in that year, when you're making a deduction, so this theta is between 0 and 1. So suppose you are doing, 50% of the reduction. I think I'll have an example here. But if you are doing a 50% reduction here, and the rest of this will follow this schedule. Okay. So the idea is straightforward. Without going to the math, I think I'll also make my paper available. So the idea is straightforward, right? For some firms where their discount rate is high, right? With this R is high, they get benefited more. Because think about it, your discount rate is all in the future, right? And that is going to affect how much constrained you are, right? So the higher is the discount rate, the more benefit you'll get, because you're pushing all that future to today, and you are taking all those deductions from today, right? So that's basically the idea. It's all about, like, if you have a very, very basic accounting and finance thing, it's all about present value, right? So if in terms of present value, the firms which have a high discount rate, they'll get benefited. And which firms will have a high discount rate? It's basically the firms which are financially constrained, who will be, paying a lot of, will be paying, a higher interest rate. They'll get benefited more from these incentives. So it's not that the firm is not paying taxes. Okay, so it has to be very clear, right? The firm is paying taxes, but it is moving all of its future, the net benefit to today. Okay, and that's basically the variation we're going to talk about. It for some firms, because their discount rate is high, and because their cost of capital is high, if you move all of these deductions today, they get benefits. So it's all about that, right? And then it basically means that the firms, and again, it really depends on what type of machines you're buying. So what I'm going to use in this paper is the type of industry you are in. Okay, so if you are in an industry where most of your asset duration is, say, 10 years or 15 years, so think about electrical power, natural gas, or rail, right? Here, your machines can be, 15 years age or 20 years age, right? Which basically means that you have to follow a longer schedule, right? You won't be able to depreciate all of your assets in 5 years. The regulation, accounting regulation, requires you to, depreciate your assets over, say, 10 years or 15 years, which basically means that you have to wait for 10 to 15 years to expense everything down, right? So that's basically, this is the treatment firm, right? And now, and these firms are probably, also be more financially constrained because, you have these, lumpy assets which cannot depreciate immediately. When I'm talking about depreciation, it's only in terms of accounting, not in terms of the usability. Okay, it has to be very clear. When I'm saying I'm depreciating my asset only in the accounting terms, so that I can expense everything out and sort of use those, like reduce my tax dollars, right? Like how much the money I'm paying to the IRS, I can reduce that. So this is what I'm sort of doing is I'm moving. So when I'm giving these incentives, I'm moving everything down to today and say that, you can expense everything down, and who will get benefit? It's basically the firms who have a longer duration for their asset to be get deducted in the future. You can now immediately do it compared to the control firms who have shorter duration. So that's basically the treatment control group setting we're going to use. And I think this follows the previous paper. We're going to calculate this Z measure. So think about this Z, whatever this Z I'm sort of talking about is like, how much are these incentives? So it's basically like higher is the Z, more are the incentives to the firm. I think that's the easier way to think about this measure. Okay, so what's the database? So any clarificatory questions before I move to the database? Like, is there any questions on what's my treatment group, what's my control group, what's my identification? Okay, so the data is going to be unique. So I think this is not that easy to get data. So what we do is I bought this data from this company called EDA. What they do is that these firms, this particular company, what they do is that they download UCC filings. What are UCC filings? I'll show you. This is basically UCC filing. So all firms in United States, if you're purchasing an equipment and that purchase is, it's not a cash purchase, it's on a loan. Okay. So suppose I'm buying a machine and I'm taking out a loan from a bank, then what and the machine is a collateral, then again, all of this database is based on the fact that there is a loan attached to the machine. If I bought a machine and I've bought it on a loan from the bank, then what the bank does this filing called Universal Commercial Code filing, which basically putting a lien on the asset that, if a firm gets bankrupt, then I'll be the one to have a first control on the asset. Okay, so that's basically the idea of these UCC filings, and all of these are public filings, which basically means that the banks can have a control on the asset. So which bank will have a control on a given asset is dependent on who has filed these UCC filings. Okay, so that's the reason why all these UCC filings are done by the banks, and they say that I given out a loan to this company, and this loan was given for this particular machine in this year and all of that, right? So that's all information is there. So if you see this particular thing, so this is a simple example of a UCC filing. So this filing was done in a Delaware state, where it says that this is a 3M is a debtor company, and this is a financial company, which is a Caterpillar Financial Services. This is the firm which has given out a loan. The loan amount is not there. So it just has to be clear that the loan amount is not there. It just says that, there is a machine, these guys have bought from us, and this is a particular ID for that machine and everything. And whether it was new, whether it was old, where the machine is located, all that information is there. And the only information which is not there is the value of the machine, and which is very important. And this is where this company comes out, the EDA. What they do is that they'll collect all this data, put all this data together, but also do lot of collect all that data of auctions of these machines from different sources to get the estimated value of each of these transactions. Okay, so if a particular machine is bought, say a tractor or a mower, right? What they do is that they go ahead and collect this data on estimated value of the machine in a given year, for that, right? So which basically means that how much is the value of the machine. So you don't really have an actual price. So let's be very clear. You don't have an actual price, but you have an estimated value for that machine collected by this company. Okay. And also you have information of whether it's a new machine or an old machine and the type of the machine, all of that, right? So that's basically all that data you need to test the hypothesis I showed you before, right? You need to sort of know, whether firms are buying new and old and how much is the value of that machine and all of that. And this is how you're going to go ahead and collect this data. So in terms of the basic empirics, So the first test that I'm going to do is, just the basic on whether these incentives are actually working, in the sense that are they, our firms are actually, making an investment in new capital. If I tell them, go ahead and invest in new capital, are you actually doing it or not? So this is the first test we are doing. We're going to sort of regress this on the, at the transaction level, that, whether the machine which got transacted, was it a new machine or an old machine? And then you basically, put your main variable of interest, which is the weighted present value of these tax benefits. And this variable is going to move with the industry and time. Okay, so which industry then and what timings? So this theta is going to sort of change based on, these incentives, how these incentives are moving. As the bonus depreciation increasing or decreasing, I think in all of that, it's going to change this theta. And the Z measure is basically going to capture the Z with the small j, is going to capture the industry variation. Is it a long duration industry or is it a short duration industry? So this is what this measure. So think about this is not your standard diff and diff. If you know some of that, it's not that standard treatment and control, but it's like, I think about a continuous form of treatment and control. And then you also include, the firm controls like, firm age. Again, so this data, I cannot control everything, because this data is available for small businesses. So what all is available is the size of the business in terms of sales and number of employees. But if you ask me a question like, do you have, their tax returns, or do you have, like anything on the, whether the firms are making enough profits or not, I don't have that data. Okay, so that's the another issue with the data. Although you have these good things about the data, that you can transact and you can sort of see all of that, all the transactions. But again, the firms are not large enough to sort of go ahead and get the data on, whether the firm is profitable or not, right? Because these tax incentives would work, or at least should work. If the firm is not even making profits, then there is no point of getting these investments, right? Because if I don't have a profit, I'm a loss-making company. Then how am I going to use it? But another interesting thing is you can actually carry forward some of these tax benefits. So even if you are making a loss today, at least for a couple of years, you can actually carry forward some of those. And again, in this data, we're going to include, fixed effects like buyer fixed effect, industry-specific trends, and machine-specific trends, and all of that, to sort of make sure that we are not capturing anything specific to a particular machine, anything specific to industry or something, and we can control all of that to test the first main hypothesis. So what we find, okay, so this is the first shock, which is the bonus one. And what we find is that, in the first, before the shock, there is no effect. And if you look at the difference between the long duration versus short duration industries, what we find is that, these incentives are working. At least the firms are buying new capital with the first shock. And this is kind of an increase of like almost 8 or 9% from whatever the base was. Okay, so this is the effect of the first shock. And even in the financial crisis, we saw there is an increase in these incentives. And again, because these incentives taper off in the future, in 2011 they reduced to again. So what we find is that there is a reduction, and in fact it goes back to, like, again, these incentives are not permanent, right? So you see that temporary effect and sort of goes down, right? And that's basically you see in the data that these incentives are working. Next, I'm going to show you is the placebo. So what happened in 2017 is completely different, right? Instead of giving incentives only on the new capital, the Trump administration came out and said that, you can obviously take these incentives and, we are going to increase the bonus depreciation from 50 to 100%. But it says that no matter you buy a new capital or an old capital, you'll get the incentive. Okay, which basically means that there is no extra benefit of buying a new capital, right? Even if I buy old capital, I'll still get that incentive. So on one perspective, it's very nice, right? That, the firms who are constrained, they'll probably go ahead and buy the old capital directly, and then this thing will, they can just go ahead and then, use these, incentives to directly cut down the tax bill, right? Which is the kind of a direct way. Now think about the indirect effect, right? So what was the indirect effect of these incentives? The indirect effect was that, you give incentive to the new capital, which basically means that some firms are going to buy the new capital, and probably they will sell their old capital. And when they sell their old capital, the price of the old capital is going to go down, right? That effect is not going to show up in the data, and this is what we find also, that firstly, the first effect itself, that firms are buying new, is not there, because now you're giving incentives to both new and old. So the first effect itself, that some firms are buying new capital, is not there, right? So there's no differential effect of new and old here. So that's basically the placebo here. So again, all of these results which I showed you in the figures, now they are in the data form, in the table format. You see an increase in the purchase of new equipment, and this is like in terms of the numbers, it's like probability of buying a new machine increases by 5.3%. Again, bunch of controls and fixed effects are there. I'm not going to the details of that. Then what we also test, is it on that the firms are buying new, or obviously some firms are buying old, right? So does that also reduces the vintage of the machine? Okay, so what we find is that average machine purchased in the data has an age of 3.5 years. Okay, what we find is that there is a reduction also. So again, this is a standard OLS regression. We also tried like logit probit for the first one, but given that you cannot have tons of fixed effects with the logit or probit, so that's one of the reasons we also did this continuous measure, which is using the machine age. And with the machine age, you can always rely on the OLS, and with the OLS with the fixed effects, this is what we do. We basically show there is a decrease also using a continuous measure of machine. We find a reduction in the machine age by 6 months. And not only we look at the machine age, but also look at the model age. So sort of talks about like, do firms also invest in the older one, or older technology versus the newer technology? So that's where we have the model age of the machine. And we also saw that there is a reduction. A typical machine which is bought in the data has like a 7-year model. So think about like, a model is there and the model is say 7-year-old. There's not much of new introduction. And what we found is that there is a reduction in the model age also by 7 months, right? So I think all of these results sort of goes to the direction that on average in the data, you see that when you give incentives to the firm, they go ahead and actually buy new capital, or the likelihood of buying an older capital goes down, and also the machine age and model age also goes down, right? So that's basically the first hypothesis. Do these incentives work? Yes, the answer is yes, they actually work, and there is an increase in that. Now the next question is which direction these are. Like, is it like you give these incentives, are these who is basically buying this new capital, or who is buying the old capital, right? So if you just think about like direct financial constraint story, the direct financial constraint story says that oh, the firms are constrained before, now you're giving incentives to the firm, so now they can go ahead and buy new capital, right? While if the capital reallocation stories hold, then even despite these incentives, you actually see the firms which are constrained, they're actually buying older capital. Okay, so this is where we were going to test the financial constraint story, where we're going to look at what's called the 3 different measures of financial access. Obviously, it's harder to find any proxies for financial constraints. So we start with the very standard one in the literature, firm size and firm age. Older firms considered as less constrained, larger firms considered less financially constrained. So that's the first measure we use. And then we also use 2 other measures. So the next measure we use is basically based on SBA lending data. So SBA in US is a government guaranteed programs. What they do is that they basically go ahead and say like give out loans to small businesses. Okay, and all these loans are guaranteed and supported by the federal government. Okay, so we're going to use this SBA loans as a proxy and sort of say that the areas or the industries where you have tons of these SBA loans, these are probably the industries where you have more availability of loan. And again, all of this is independent to whatever we have in the data, right? So it basically means that if the federal government is giving a lot of these loans or whatever in a given industry, probably these places will have are less financially constrained. And that's one measure of constraint, which is measured using at the industry level instead of going at the firm level. Third is the geography level, which basically the previous research
Once it seems.
Yeah, I think something at Manpreet's end. We'll just fix it.
आलू दम बना रहे हैं लोग क्या?
हाँ?
आलू दम बना रहे हैं ना ये लोग?
Just want to check if you guys can hear me again. I think there was a network issue.
Yes, we can hear you.
Perfect. Okay, so I think let me sort of come back to this slide, which I think maybe it was lost in the network. So what I do is basically I use three measures of access to finance. You guys can share my screen also, right? Okay, perfect. So basically, yeah. So basically, I use three kind of measures for access to finance. One is just purely the firm size, which basically says that if you're a larger firm, you're less constrained. If you're a smaller firm, you're more constrained. So that's the first measure. Second measure is based on you're in an industry where the Small Business Administration gives out a lot of loans, right? So if you're in an industry where the SBA lending is more prevalent, then you're probably less constrained. Okay. And then third is that you're in an area where there are a lot of small banks. Okay, if there are a lot of small banks, then you're more likely to get a loan, right? So this is basically the three dimensions you can think about access to finance. And now the story I'm going to test is that who's buying new versus who's buying old, right? So on average, we saw in the data that when you give incentives, the firms are buying new. Now the question is that if it is a direct effect of tax incentives, then you probably think that oh, the firms were constrained before, now I give them a shock, I give them incentives, these are the ones who will be probably buying the new, right? Which basically means it's a direct effect story. While if it is an indirect effect story, then the firms which are constrained are actually buying older capital, and that's what we see in the data, that on average, the firms which are more constrained are not buying the new, but are buying the old. And why they're buying the old is because the prices may have gone down. And that's what I'm going to show in the next one, that if the capital reallocation effect story is true, then you should see these effects instead of the opposite. And now I'm going to sort of show you the third effect, which is the price effect. Okay, so as I sort of talked before, that you give tax incentives to the firm to buy new capital. When they buy the new capital, there will be an increase in the supply of old capital. Again, it all depends on how much is the supply and how much is the demand. If the firms are buying new and some of them are replacing their old capital, then you probably see a decline in the price of old capital. Okay, I cannot show you this piece, but I think I can show you this piece. Okay, which is whether the price of old capital is going down or not. So what we are going to do is we're going to look at a particular machine. Obviously, I'm just going to sort of talk about one particular example, and then I'm going to sort of test all of this in the data. So think about a John Deere windrower. Okay, so what we saw in the data is that the average price estimated value was $61,000, while for an older machine of the same type, exactly the same type, it was $34,000. Okay, so we can create this measure called old to new in the data. And we also do other than the ratio, we also do the old and new separately too. But these are the three measures we're going to use. So what we found is that if you just look at the old machine separately, there is a decline in that price. Again, all of this is averaged out at the industry level. So there is a decline in the price of older capital. We do not see an increase in the price of new capital. Okay, so remember this was the first question which Professor Ravindra asked, that you're giving incentives to the firm to buy new capital. If there is not enough supply of new capital, probably the new capital becomes expensive, right? And these incentives won't even work, right? So this is something we don't see in the data. We don't see an increase in the price of new capital. So prices have not gone up. Okay, and also the price of old capital has gone down because there is probably enough supply of old firms that are probably replacing their assets, and that's what we see. That probably pushes the price of the older capital down, and that's how the ratio of old to new is actually going down. So this is what we see, that there's a decline in the price for old capital by almost 2 to 3%. We are revising part of the draft. I think what we are doing in the future, instead of running these regressions directly, we are actually running the regressions with the residuals to sort of make these estimates better. I think I don't have time to sort of discuss those, but I think the results are consistent whether you use this method or we use a residual method, where we try to like control for a lot of things and then estimate these regressions. We find something similar results. Okay, so that's basically the mechanism we have so far. And then the final test, before I sort of go to my concluding slide, is on the real effect. And I think we are going to add more and more to this. I think we kind of started with this real effect in the last few days. Is that okay, I told you the story is this, right? I told you the story that you give incentives to the firm, and especially make the new capital cheap by telling the firm that if you invest in new capital, then you'll get these these subsidies, but if you don't invest in new capital, you don't get it, right? So this basically means we are telling the firm that go ahead and invest in new capital. When the firms go ahead and invest in new capital, some of them probably sell their old capital. If they probably sell their old capital, it's going to increase the supply of old capital and will push the price for the old capital down. And given, I think there's a theory paper which kind of sort of talked about before, is that old capital prices are also high in equilibrium because of the financial constraints. Okay, so now if you push the price of old capital down, it may help some firms to actually enter in the business, because I don't even have money enough to even go ahead and buy even older capital. Now, if the old capital becomes cheap, probably I'll go ahead and start my new business. And that's basically what we see in the final slide here, that there is an increase in all of this is new entry. So there is an increase in the count of small businesses after the shock, and most of this effect works when ex ante the prices were high. Okay, so if ex ante old prices were high, and now in ex post sense the prices have gone down, so you'll see more entry in those areas. So think about like a standard story, right? That you give these incentives, and the incentives not only directly help the firm in making investment in new capital, but also encouraging the firms which are not able to invest before, but now they can, because the price of old capital goes down in the general equilibrium, and that sort of benefits some of the firms indirectly. And that's basically in a nutshell we test in this paper. So let me kind of conclude here. So overall, our results sort of document, this first effect of, this indirect benefit of this capital tax incentives, because these incentives alleviate these financial frictions and sort of foster, the physical capital reallocation, and which is quite important. So these tax subsidies on new investment increases the supply of old equipment and lowers the price of old equipment's relative price. And this creates this positive externality for the constrained firms who are net buyer of the older capital. And this reallocation towards financially constrained firms helps in business entry. And I think from the policy perspective, sort of give you a bigger picture of the paper, is that I think typically when these incentives are designed, you always think about, and then there's always this debate, right? How should you design it and how you should not design it. So think about, the first two policies in the 2001 to 4 versus 2008 to 10, these incentives were given only on the new capital, while in the Trump administration, they've given these incentives on new and old both. Okay, so what the paper sort of concludes, that you have to sort of be careful in designing these incentives. If you give both incentives to the firm in new and capital both, what actually shows in the data and also in some of the theory, that it may have actually hurt the firm, because now you're not incentivizing the new capital, So not all firms, go ahead and, invest in new capital and everything, which basically is you're reducing economic growth. You're not encouraging firms to invest in new capital, right? While, you can always take a different perspective and say that, oh, I'm sort of, giving firms to invest both in new and old capital. So which basically means that I'm being more inclusive, right? But you're actually not inclusive because you are encouraging firms to also invest in old capital. While if you think about the first two stages, right, 2001 to 4 versus 2008 to 10, in these policies, what you did is that you told firm that, you go ahead and invest in new capital. Okay, so which basically means a lot of firms who could afford, they go ahead and invest in new capital. You're encouraging the innovation, you're encouraging the economic growth. While there is this side effect that you always get, from these incentives, because it will make the older capital cheaper and some firms will also enter, right? So the firms you probably care more is like, firms which are more constrained and they're, they will also indirectly get benefited, which you probably don't see right now when you sort of design the policy, but it's actually true, right? So that's the reason it has to be very clear that, how you design your policy. So you have to sort of think about like, are there just the direct benefits or there are these indirect benefits also coming in because of the G effects? And I think that's the first way we're going to sort of talk about is, these general equilibrium effects, which comes in because of these indirect benefits, which will come in because of, prices of old capital going down. Yeah. So that's how I'm going to end my paper. Thank you.
Manpreet, so your final conclusion was that it's a better thing to focus on the policy be on the new capital only rather than new and old.
Correct.
Anyway, we may have debates on that, but I would invite now Lakshmi Naaraayanan.
Thank you so much. Can you all hear me? Okay, let me just now try sharing my screen. Okay. Can you see my slides? Okay, yes. And can you see them moving?
Yes.
Okay, fantastic. Thank you so much for the opportunity, Dr. Charan Singh, Professor Dholakia, and Dr. Manpreet Singh for allowing me to think about this paper and kind of think through some of basic micro economics going back to PhD days. Okay, so let me kind of start off. Let me summarize my view of the paper, just in case the paper is quite heavy on many things. So I just wanted, for the sake of myself and for disciplining my thought process, I just wanted to kind of quickly summarize the paper. So paper in a nutshell is, think about, you're a small firm, you're trying to buy $1 million in computer, right? There is a particular kind of, deduction schedule through which you can depreciate this $1 million in terms of computers. Now that varies for computers versus some of the other equipments. Let's forget about the details for now, right? So this is effectively how the schedule would look like had we been in a world where the governments don't intervene and try to stimulate investments through these accelerated depreciation bonuses, right? So if you kind of compute the NPV, just taking Finance 101, and if you kind of just take a particular discount rate, your favorite discount rate of say 7%, 10%, you would get that the NPV for this investment at normal times when there is no depreciation would amount to say 311,000 US dollars. Now comes in Manpreet's paper, which says let's think about a scenario where the government intervenes, right? And it gives you 50% bonus depreciation, and that varies over time, right? So let's take the same equation now, just do 50% bonus depreciation. What effectively that means is, you had 1 million investment in your computer. You can immediately depreciate 500,000 of it at time 0 when you purchase it. Plus, you also get the 20% benefit of the depreciation schedule that comes with the regular law, and that effectively means that by at the time of purchase, you have paid off 60%, or you're allowed to depreciate 60% of your purchase value on new capital goods, right? And that effectively means that if you compute the NPV with using the same discount rate, say 7%, 10%, whatever it is, you're going to get immediately a benefit of $20,000, right? Just by virtue of shifting your cash flows, in the future to today. and effectively using a discount rate that's going to vary between me, Professor Dholakia, Professor Singh, and Professor Manpreet. It's going to vary across, and that means that each of us is going to value investments in these new equipment differently depending on our discount rate. And that's the essence of the paper, is that it's going to use this measure from Zwick and Mahon's AEJ paper, and then try to argue that there is a reallocation effect. So what do they find? Quickly summarizing, just in case you're wondering, with all glittery images of tractors and stuff, is effectively that if you give bonus depreciation or accelerate depreciation to new capital goods, effectively what they argue in the paper is that it's going to lead to relatively more transactions of these new equipment in industries that potentially benefit more from these changes in tax code, by virtue of shifting cash flow. They also show this, if you look at machine age, effectively, if you look at different models, you find this effect to be consistent. Or if you look at machine vintage, you again find this to be consistent. The second thing is, of course, financially constrained firms, and this comes from Zwick and Mahon's paper, is that financially constrained firms benefit more, and these kind of accelerated depreciation initiatives are going to relax financial constraints for these firms, and they use these three measures. I'll not go into too many details into it. And in terms of mechanism, they argue that there's a price mechanism that happens, wherein new capital goods versus old capital goods are going to push the price down for old capital goods. And effectively, that pushing down of price allows some entry into this area in the form of new businesses, and also demand from existing businesses which previously could not purchase because they were financially constrained to begin with. And lastly, they do a lot of robustness analysis, and it's almost a complete paper, as with any paper that Manpreet does. It's fully comprehensive and takes care of many things. So my initial impression and reading of the paper is it's a very important and relevant question, especially pertaining to the objectives of EGROW and other markets which are thinking about ways of economic stimuluses to benefit both small firms and also investments at the larger case. At a larger pace in the growing economy, maybe especially after we come out of this COVID pandemic. And they do a compelling empirical exercise. They provide a novel set of results, and it's a very rigorous paper, right? So my comments are going to focus on mostly two things. I'll leave the other suggestions and share the slides with Manpreet later on. It's going to kind of structure all these results together, and that if the paper's objective is to present an analysis of reallocation, how should we go about thinking about it, and kind of think from that perspective. And conditional on whatever we find in terms of the results, what do we interpret, and what are the underlying mechanisms that seems to be driving it. So let me kind of quickly, to the best of my ability, sketch a simple model about a new decision between investing in a new capital good versus an old capital good. So this is just a framework that I took from Hall and Jorgensen, the idea being the firm is trying to maximize its present value of after-tax cash flows with a stock of debt DT and a new investment IT. So IT, you can think of it as an investment in new capital goods, and ITC is going to tell you the present value of investment tax credits that's going to boost firms' profits today and make this intertemporal trade-off, right? And effectively, in this neoclassical model of investment, if you solve the first order condition, you're going to get this wedge that comes from ITC in this expression. And the idea being that the theory would predict that any time the ITC creates a wedge between new capital and old capital, every dollar of this wedge would be directly translated to every dollar in terms of investments in new equipment relative to equally productive old equipment, right? So every dollar will, anytime there is a wedge, this wedge will directly translate, holding constant many other things. And I think that's where my comments are going to focus on, right? So the fundamental assumption in any model, not just this model, but any model that the paper is going to allude to, is this idea that new and used machinery are perfect substitutes, right? So going back to the example of in Manpreet's scenario, the tractor cannot be used fundamentally in outside of, say, agriculture, construction, etc., not in utility. So there has to be a sense in which the new and old machinery are perfect substitutes. And over and beyond that, there's an inbuilt assumption that increased investment in this new capital sharply decreases the marginal product of the used capital in and of itself, right? And going back to discussion from Professor Dholakia about thinking about how should we think about the demand curve and supply curve of new goods versus old goods, right? If you take an example of, say, shipbuilding, where you have most of the market is built on used ships, you can clearly see that maybe the supply of ships, new ships, is very inelastic, because it takes time to build ships, so on and so forth. But the used ship market is very liquid, right? So effectively, there is an interaction between increased investments between new capital with the marginal product of used capital, right? At the same time, all the analysis will also require, and even in the model, will require assumptions that any aggregate shifts in the demand are unlikely to be correlated, that are going to differentially affect the productivity of new capital relative to old capital, right? So in my example, that for every dollar of income tax credit, the wedge is going to fundamentally depend on the marginal product of the used capital to be equal to the marginal product of new investment, meaning that the productivity is the same, and conditional on productivity being the same, you're going to decide to invest for every dollar, right? And that effectively means that the only reason why you see a relative movement in prices, as Manpreet documents in his paper, is going to be driven by only tax incentives and nothing else. Okay. So if that's the case, let's kind of take this theory to measurement, right, and apply this in the context of this paper, right? So they are going to take this framework from Zwick and Mahon, and they're going to argue that there are industries that are most affected, and there are industries that are less affected. This is, I don't know if this is table 2 or table 8, IA2 from the paper, which is just giving you a sense, right? Now, applying this framework to this particular instance, first thing that we have to define is a sense of reallocation, right? How should we think about reallocation, right? So in Manpreet's presentation, the sense of reallocation came from big firms and small firms. So there was something happening with big firms, something happening with small firms, right? However, that's not sufficient a condition to explain reallocation or to even think about reallocation, right? So if I were to define reallocation, I would say machines are changing ownership across buyers from different industries. But if that's the case, then we really don't know what are the complementarities across industry. I really don't see how a tractor that's used in crop production can be used in rental and leasing services, right? And if that's the case, this means that reallocation in the paper has to do something within industry changes in ownership across buyers, right? And that means that there is role for exploiting and understanding what are these complementarities and when would these markets work, right? So think about customer-supplier relationships, input, outputs, etc. Right? So I kind of encourage the authors to think more about what are these complementarities and what are some of these effects that are driving, right? Then second comes the assumption that new and used goods are perfect substitutes. Right? Again, going back to the tractor example, it's not very clear that they have to be perfect substitutes. Much of the theory work or prior work assumes that constant velocity of substitution is perhaps greater than 1, assuming that they are perfect substitutes. But that's necessarily not the case. If there are time-varying demand shocks and that affect industry over time. Right? And I'll show you an example in the next slide. And lastly, suppose we find there's a reallocation effect, right? How should we think about these effects only operating through the capital reallocation channel, right? The challenge is that it could be operating through other markets, and that is fundamentally going to affect the capital markets also. And that's important because at the end of the day, as a policymaker and as a government, we want to understand what's the mechanism that's driving this, and that concomitantly has different welfare implications. And I'll talk briefly about a few of those. Right? So let's kind of take to the empirics and try to kind of think a bit more about what are the identifying assumptions that are crucial, right? So here I'm just plotting, from the EGROW paper, new prices of within construction machinery industry and old prices. So this paper kind of shows, and it looks at, again, the two instances of bonus depreciation as Manpreet's paper does. And it effectively shows that the price of new equipment kind of remains very flat, whereas you see a different temporal variation in terms of how it's affecting during the 2002 bonus depreciation or 2001 bonus depreciation rule versus 2008. And the fundamental reason why it's differing in 2008 because there was a collapse in the demand for housing, and that's fundamentally affected the demand for used machinery, but it did not affect the demand for new machinery. Right? And that effect, and I know that Manpreet does quite a bit in terms of having high dimensional fixed effects, etc. But I think this comes from a within industry perspective as opposed to a cross industry, and it would definitely be helpful to first define how we think about reallocation so that everybody's on the same page, and then structure the thoughts in general, which is to say, well, let's take the firm level equipment. Let me first show you that what happens to total investments. It's consistent with prior research. Then let me show you at the firm level or at the industry level what happens to new equipment purchase, old equipment purchase, and then show you at the industry level what happens to small firm, big firms, and then kind of show you the net effect at the industry level. So that's my sense of what a reallocation should be. Maybe it's not the way that they're thinking about reallocation. If that's the case, it's perfectly fine. But I think it needs more clarification. Otherwise, I'm always kind of guessing whether the reallocation is happening within industry, across locations, and unable to discipline my thoughts. And that might just be my reading of the paper, right? Now, conditional on we establishing that there's a reallocation within an industry, it's important to understand what are the interpretation and mechanism, right? So here I offer some interpretations, right? So suppose if it's true that we find there's a reallocation within industry, right, from big firms to large firms, is it telling us something about technological obsolescence, right? Why isn't the supply of new capital responding? And is it then telling us that, capital replacement in the economy is suboptimal? And if that's the case, then it has, a welfare decreasing, angle to this, because, now you are seeing that there's not enough creative destruction in the economy, and by subsidizing certain set of firms in the economy, we are giving up aggregate economic growth. The other interpretation is, if both, firms are, competing in the same labor market and capital markets, one interpretation could be just that, this suggests to us that smaller firms are moving towards automation, right? And there's a lot of work by Darren Acemoglu and co-authors, which suggests that firms do compete in the markets. And also, as Manpreet's presentation highlighted, much of the work in this literature also shows there are labor effects. So is it the case that it's only a capital reallocation effect that's driving this? Or is there a labor channel that's feeding into this capital allocation effect? And what we interpret or what we see as reallocation is just a move towards automation. There's nothing wrong with it. It's just an interpretation of how we should take these results and think more carefully about them, because there's a lot of conversation and discussion how automation is going to affect, and hence it's not very clear in this setting that if we take this interpretation, how that translates to welfare in general. The third thing is, new and old goods are also different in terms of their collateralizability, right? So as bonus depreciation is kind of added to it, it also changed the relative collateralizability and redeployability of each of these assets. Now, as a lender, and given that much of the data comes from UCC filings, it's all about collateralizable assets. So if that's the case, then we are really learning about lenders' preferences for certain type of capital goods as collateral and their ability to redeploy, which prior theoretical work and empirical work has shown to affect pricing of goods in general. Are we learning about differences in market structure, right? So as Professor Dholakia mentioned early on, right? Are we really interpreting the evidence of price as an equilibrium effect, or are we learning about different market structures for new goods and used goods, right? Going back to my previous example, we saw that during the 2000s, if you look at the construction industries, old versus new prices, we saw that the new price remained flat, whereas price for old goods kind of varied over time. Right, so that's telling us something that maybe new goods react differently or have a different market structure, and we learn effectively about market segmentation for capital goods in general. Right, so there are many more, and I'll in the interest of time, I'll stop here. And there are many other suggestions, and I'll kind of share this with Manpreet. But overall, I think this is a very interesting and relevant paper and very timely paper. And it's really important to understand, the reallocation effects and its link to tax incentives. And I think my suggestions, as a reader who's outside of this literature, is to kind of, the starting point is to discipline our thoughts in terms of, defining reallocation more clearly, and only focus tests that sharpen it, and take out all these tests about, business formation, etc., which I don't think are relevant to this conversation about reallocation. Personally, maybe it's my interest that I'm biased, that reallocation itself is important, and I think this is an important enough question that it merits a paper only on reallocation. And again, once you find this reallocation, I think it's important to also interpret some of the findings, disciplining either with prior work or with the model. And I look forward to reading the future drafts of the paper, and would like to thank you for providing me this opportunity to again think about this very nice paper and to read it. Thank you so much.
Thank you, Professor Naaraayanan. It was a very crisp and very comprehensive kind of the comments. Well, Manpreet can respond to that, but I would suggest we take all the questions from the floor first, and you can note down and respond at a later stage. The point that I think you have missed in the paper, and which is very, very succinctly pointed out by Lakshmi Narayan, is that it is the substitutability and the degree of substitutability. I think all the vintage models of growth invariably talk about the new capital and the old capital. This new and old capital cannot be and would not be fully, perfectly substituted. Because if they are fully substitutable, then there is no justification for providing differential treatment to the two things. If the differential treatment is justified, then it is necessary that they are not perfectly substitutable. I mean, one is superior in many respects than the other. The second important matter is that you should also consider, I mean, say when the Trump administration talked about treating the old and the new capitals together, I mean, more or less on the same thing without discriminating, then the whole issue will be that is the depreciation treatment available on the existing stock of the machinery? You know, because no, it has to be new, right? Okay, that means you have to buy. Now the question is that if suppose you have to buy only the old machinery and the new machinery stock doesn't increase at all in the system, then the whole question will be that why, I mean, in what way it's an incentive or it's an economic decision. Anyway, one has to justify all those matters. Think about that when we discuss this matter further. I think the other important question, while you know the developed countries scenario is different, because there are well developed capital markets and labor markets in both the countries. For country like India, you will have exactly the opposite situation. The markets are not at all developed, and there are tremendous imperfections in the capital market and more so in the labor market. I mean, you will have the question about the labor which is going to be associated with the new machine and its skill levels. It cannot be the same worker who is going to operate the same different new machine. He will have to be trained. So these are also the costs, and these are also the things which will come into the picture. I think at the end of the day, your exercise is only, I mean, confined to the finding of the capital reallocation effect, if I may say so. But the question is that capital reallocation effect has to do something with the productivity of the capital, overall stock of the capital. I think that you can't miss out. Unfortunately, your data do not provide this kind of the exact testing. Something will have to be addressed at that point. Anyway, I'll stop here. We can get the questions from the floor. And Charan, I would advise, please, you handle this part, okay? That is, you know, inviting the people to ask questions. Yes.
But we have quite a few questions in the chat box. If Dr. Manpreet or I think Dr. Manpreet, you can have a look at the chat box. There are quite a few questions there, right?
I think one question was already on the. Yeah, I think one question on the, I think the null hypothesis. I think that was already clarified in the presentation.
Right.
I think there was a question on the regression type, and I think I already told that when I was presenting. I don't see any other big question there.
All right. Okay. I think then if there are anyone who wants to ask a question, please ask now. I think there are no more questions, and I think I have liked the presentation myself, so I have no questions. And you can then, Manpreet, you have the chairman.
Wait. You have liked the presentation, therefore you don't have any questions. That is the wrong way of saying. I also liked the presentation, but I had questions. And I'm sure Lakshmi Narayan also liked the presentation and he still has the question. So this is not an excuse. You don't have question, that is fine. Plain. Good. All right. Manpreet, please go ahead.
Yeah, so I think a couple of things. Right? Starting with the substitutability, and I think I struggled with this a lot when I was actually going through this paper. I think I started this paper like I think almost a year and a half back, and I think in this Christmas time I wrote the first draft in last year. I think I was like reading all this literature on vintage capital and growth, and then I think the reason I kind of did not go to that direction is so there is this that literature, and I think the literature I'm sort of going towards, and I think I didn't get time to sort of talk about. There's a more recent paper by Rampini and Lenteri, and I think both these guys are at Duke. So what they do is they write a little bit of simplified model. I think my predictions, most of my papers predictions are coming from that model, which I didn't get time to sort of talk about. It's basically, I think what the model kind of assumes that the productivity is not necessarily similar, but the prices will take care of that, right? So the reason why the old capital is cheap and the reason why the new capital is expensive, it's already clear that there are underlying factors which make them different, which obviously includes productivity, right? Although you don't directly say upfront, right? But I think that's already underlying, right? That you don't have to assume a lot as the price, because the prices can just take care of them, right? So the substitutability, I think the way I ran these regressions kind of obviously means that and you may think that I'm sort of talking them as substitutes, but they're actually not. The reason is that think about my first predictions, right? Like my first assumptions were like, the firms which are constrained, they're buying old capital. And the reason why they're buying old capital is firstly, the old capital is cheap, but obviously the reason why the old capital is cheap because it's less productive, right? So that's basically is already underlying there in the prices. You don't have to really, upfront say it. So that's probably the reason why I didn't say it, but I think the prices just take care of all of that. So that's one of the...
Manpreet, the issue is that, the prices of a capital good will be different. Cheap and expensive will have to be, considered relatively, because, the whole thing is that if the total lifespan is say 10 years, and if I am selling something old, which is after 2 years, it is now available only for 8 years, and therefore the price is going to be less. There is no doubt about that. So cheaper and expensive do not reflect this part completely, because what you are saying is, in fact, this opens up another era. I mean, another box, because the moment you talk about the second-hand dealings, I mean, it is the depreciated book value, which is again the accounting thing. And if you are getting more than the depreciated book value, that is also taxable because it's a capital gains.
Right.
And the question is that therefore, if you assume that it is the depreciated book value which is only going to be realized, then there is no capital gain and therefore there is no tax liability. Right. Now the whole thing that happens is that when the incentive is provided, the tax incentive is provided, in future, the same capital good will now be available at a cheaper rate because the depreciated book value on the books will be now much less than the actual economic value. So I think these are the complications that will get added.
Right, that's true. I think I kind of wrote a footnote on it, but I never got into this whole thing about capital gains, because I think there are certain other regulations on it. Like if you go ahead and buy, I think so. Let me put it this way. I think the thing is this, right? Like with this whole incentive, are you bypassing the whole taxes? Actually, no. So IRS sort of kind of make sure that you don't pay lower tax, because I think the income tax versus capital gains tax have a different value too. So they try to avoid that. But I think going back to your point about like substitutability, I need to think a little bit more on that, because I think the way I read the theory paper kind of assumes it. In fact, I talked to Rampini about because I think I think the reason I was my paper is much close to that theory paper, and it has less to do with the productivity, but I think it's important to sort of discuss in my own paper how at least the assumptions are in terms of the productivity. So I think I'll just think about that. Going back to the TCJ 2017 new versus old thing, I think the different ways to think about it, right? Like I think they show in their model, the Rampini, I think they kind of show in their model, I think that's a pure theory model, and I think this is what they show, that if you give incentives to both new and old, what happens is that obviously you don't get these indirect benefits of tax incentives, but in fact it will encourage the firms, a lot of innovative firms, to invest in older capital, which cause, you're giving incentives and which is which is not Pareto efficient, right? So basically it's diminishing the growth, and that's what they show in their model, sort of talking about it. And that's why they sort of criticize the 2017 tax policy too, where they, and I think my paper is just kind of show that from the empirical point of view, that the shock is not working, right? Basically, the firms are not investing in new, or the firms are not investing in old. They are equally investing. But I think there's always an argument that that do you want firms for which, I think there is this matching, right? Like for the firms which are constrained from the equilibrium point of view, from the minor productivity point of view, you want them to actually use the older, less productive capital. And I think this is where the vintage literature is also talks about. There is this matching, right? Because the firms which are constrained, probably for them, it's better to invest in the older capital and the vintage capital, while the firms which are less constrained, they can afford to employ, better skilled worker and all of that. For them, it is Pareto efficient. The marginal productivity is much higher for those firms to buy in the new capital, right? So it's even that allocation of capital of new versus old based on the productivity is already designed in a way that the financial constraint sort of determines who should be using what kind of capital, even if the prices are not there, right? So that's basically purely from the vintage point of view. But I think going back to the TCGA thing, that that you don't want the less constrained firms to be investing in older capital. And if you give incentives on the older capital, and these are incentives given equally, right? So, and you cannot pick and choose and say that, so this is the reason why it is recommended to sort of give incentives only on the new, and let the benefit to the smaller firms to go through an indirect way rather than giving them a direct benefit. Probably that's where the whole policy design, at least that's what the recommendation is. Obviously, I think one has to sort of dig a little bit more deeper to sort of understand what the implications are for the TCGA. Okay, and I think going back to the last point, I think the productivity kind of discussed, right? I think these are the 2 points you kind of raised. And I think going back to what Lakshmi's point, I think all points are well taken. I think Lakshmi sort of, I think the reason, I think as of now the paper's horizon in terms of capital reallocation is towards firms, because the theory has everything towards firms, okay? So the whole Lenteri-Rempeni model, I think I was like sticking to that theory, where I think their idea was like, okay, let's look at the constrained and less constrained firms and think about the capital reallocation around those type of firms. I think what Lakshmi sort of want to know, and probably we can sort of have a table on that, is like, is it just the capital reallocation across the type of firm based on the financial constraint, or it can be a geographical reallocation, it can be industrial reallocation. I think some of those things are not there in the paper, but I think we can go ahead and sort of think through that also. But I think as of now, the paper kind of limits towards that particular theory model, but obviously you can broaden the scope. Probably there is another paper one can write on, as Lakshmi said, right? Like probably we can write it together, Lakshmi, on like, thinking about like a capital reallocation from a bigger perspective, rather than just, like, I think as of now, it has nothing to do with like, the tax incentives, right? Like if you think about like an industry specific reallocation or a geography specific reallocation, the tax incentives are not, you don't need tax incentives there. I think the reason we have tax incentives because you're always thinking towards, financial constraints, right? So the idea of the tax incentives to sort of think about, so the friction, I think in the model is always about financial constraints. But if you think about the industry reallocation, you think about geography reallocation, all of those won't have that friction of financial constraint, right? So that's where I think the thought comes through and like, line everything together. But I think probably we are not that clear. So probably we should write more a little and probably add a footnote that why we are not talking too much about like, reallocation across different industries and reallocation across different geography of different types, but we can write on in the paper too. So thank you, Lakshmi, for your comments. Yeah.
But Manpreet, in this context, I would say that, this entire concept of capital reallocation in this context, which you are referring to, will be only specific to the same industry and the same kind of the capital nature.
Yes.
It cannot be across
So that's
industries.
the reason, so that's the reason we throw in fixed effects. So we do estimate everything within an industry. So we don't do anything in, like the fixed effects will take care of it. So when I do the fixed effects, So I'm estimating everything within an industry,
Very
not
true,
across
very
industry.
true. So therefore, the question about geographical allocation and the industry allocation, etc., is less relevant in this context.
Yes.
In my opinion, it is the same industry, same type of asset, and you are talking about capital reallocation in terms of largely ownership. It is nothing to do with the other kind of reallocation.
Correct. I'm basically saying that you're a construction firm. Okay, one is constrained, one is not a constrained construction firm, and the firm which just started a business of, say, there's like 3 or 4 employees versus a firm which has, say, 10 employees.
Sure.
So the firm which has 10 employees giving their older capital to the firm which has 3 employees. Think it that way.
Now please have another perspective to your thing. You are assuming a sort of a full employment kind of an equilibrium. If you are already employing, if you are already into a system where there is a lot of, because of various reasons, because of the demand side factors, because of several other input side factors, some kind of constraints, as a result of which there is a tremendous kind of unutilized capital stock available. That is, capacity. Capacity is not fully utilized. In that context, this entire assumption or this entire argument would not be applicable. The whole idea is that if you are now trying to boost the economy into achieving a higher utilization, capacity utilization, then the distinction between the small, the new and the old does not become very productive. In fact, if you don't have that, you are actually pushing the growth, pushing the employment, and pushing a better utilization of the existing stock of capital. I think that is also a perspective which you cannot miss, because you are referring to the two policies and the two things in a different kind of a context. I would suggest that you cannot jump to this kind of conclusions without recognizing these matters.
Correct. Yeah, I think there is another difference. Probably, I think one has to take it with a pinch of salt, right? That the years, like when these policies were designed for only new, those were the years of, like those are like done as a counter-cyclical policy. While 2017 was not a counter-cyclical policy, right? So it's like 2017 we didn't have a shock and the economy has to come back, right? So the capacities and everything was probably different, right? So I think one has to think a little bit more carefully about, like, is it, even if it is a perfect placebo, I think I have to think carefully, because I think the first two shocks are very clear. These are like a counter-cyclical policy, right? But the 2017 is a little bit different. Obviously, it is different in the sense of, new versus old too, but I think a lot of other differences. I think what we have shown so far is that, that thing is not there. But again, that period is not a depression. We are trying to come out the economy from a bad state, right? That's not the case in 2017. So probably one has to think a little bit more carefully about, like, how to interpret those results too.
Yeah, but definitely it doesn't require an unqualified kind of a statement. You have to qualify. You have to qualify with all these things. Anyway, great. Charan, would you like to add anything? First of all, Lakshmi, would you like to respond or anything?
All good.
Okay. Charan, over to you, sir.
I'm so impressed by the discussion, learning for me too, because I've been always thinking, how do we incentivize the MSMEs? And these are the budget days these days, and we are in India going to have the budget in another 1 month. So when we selected this topic, we had the budget in mind, and if any inputs for the government on this budget. The discussion that has followed is really, for me, very, very interesting, for the simple reason that I've been thinking, are we doing anything in India exactly the way that you have mentioned in your paper, and the way you mentioned that the American system provides tax incentives for investment? Now, Professor Dholakia has provided, I think my question was answered by Professor Dholakia when he says that there is unutilized capacity, and there is, the way he put it, the employment factor. then these tax incentives probably will not work, or will not work in the direction that you are thinking of. So all this while you were doing the presentation, I was thinking, how does this help India and how does it help us in policy framing? So I'm really thankful to you for your paper and the rich discussion that has followed. And I must say, I must acknowledge Lakshmi's as a discussant, the note was very useful. And most importantly, Professor Dholakia, your inputs at every level in today's discussion has been really very useful. From the policy making, those have been very, very useful in India, in the Indian context. So with this, I must thank both Professor Manpreet and Professor Lakshmi to be with us and present a technical paper in such a non-technical way so that we all were together with you, and Professor Dholakia to have chaired this session so well that it was a great learning experience from various angles, from policy angle as well as from the academic angle. Now, today's discussion will be available on our website tomorrow by noon, and I'm sure most of us are going to use it for various purposes in the classroom or sending to friends in policy circles and to other policymakers. So please do that tomorrow when our presentation is available on our site. The next week is December 31, and I'm sure everybody is going to be in party mood. So we are also in a party mood. So we have organized a talk from 2:30 to 4 p.m. So before the party starts. And the talk is going to be simply interesting for the reason that it is related to COVID and issues, psychological issues along with COVID. So Professor Ishita Bhardwaj, who's a professor in Department of Psychology, Delhi University, is going to bring along with her other people who have contributed in the new book that she has edited. So we will be discussing about her new book, almost call it like a launching of that book. And she will be talking to us about the issues related to, and the way she was mentioning to me the book, very, very unorthodox book. It'll be interesting for all of you to see how a psychologist is approaching this subject. Because it's the eve of the new year, the discussion will be from 2:30 to 4 p.m. so that you have enough time for the party making. So I look forward to all of you joining us next week from 2:30 to 4 p.m. Indian Standard Time. And the issue is going to be psychological issues, keeping in mind what has been happening across the world in recent months. With that, let me thank all the participants to have joined us, and they were in large number today. I was a little worried, it's a technical paper, but I was very impressed. At one point, we were about 60 people listening to this technical presentation. So I want to thank all the participants also who joined us today. Thank you and good night. And I don't know, have a good day in America. We go
Yes.
to
Thank you.
Well earned sleep tonight. All right. Thank you.
Thank you, everyone.
Thank you, everyone.
Thank you.